Whether you're sitting in a BCom class, grinding through an MBA, or actually gearing up to launch your own startup, you're going to need to know how to finance it. So let's jump right into today's explainer. We're taking the massive and sometimes intimidating world of project finance and breaking it down into something you can actually use to build a business from scratch and pitch it to the world. Let's get started. Here's our roadmap for this session. First, we'll look at the story and numbers, then dive deep into CapEx and setup costs. After that, we'll cover funding and statements, check out the metrics for bankable projects, and finally, wrap up with sharing AI explainers safely.
All right, Section 1, the story in numbers.
Okay, let's dive into this. Before you start dreaming about profits, you've got to get your mindset right. I absolutely love this quote from our source material about what a detailed project report, or DPR, actually is. It says it's the story of a business told entirely in numbers and logic. I mean, think about it. Whether you're building a massive factory, opening a boutique hotel, or launching the next big tech platform, you're really just answering two questions. Does this idea make business sense? And does the math actually work out day to day? That's your financial model. It basically humanizes the math. You aren't just, crunching random numbers. You're literally writing your startup's biography before it even opens its doors.
Section 2, CapEx and setup costs.
Now here is the very first major hurdle of that story. Before you see a single rupee of profit, you have to figure out exactly what you need to buy just to get started. This is huge. We call this CapEx, or capital expenditure. These are your one-time initial setup costs for buying long-lasting assets. So say you're starting a manufacturing business. Your CapEx? That's buying the physical plot of land in an industrial hub, maybe somewhere like Gujarat. It's paying for the actual construction of the factory buildings. It's purchasing all that heavy machinery that's going to sit inside. You're not buying these things every week, right? This is the massive, foundational, heavy lifting you absolutely have to do before day one of operations can even kick off.
To make this super clear, think about building a house. CapEx is that one-time cost of building the physical structure. It's the bricks, the cement, the roof. On the flip side, OpEx, or operational expenditure, is what happens after you move in. OpEx is the ongoing, day-to-day running cost. It's paying the electricity bill, paying the security guard outside, buying raw materials, covering salaries. Basically, if CapEx builds the engine, OpEx buys the fuel.
But here's where the math gets kind of fascinating. Let's say part of your CapEx is a $50,000 delivery truck. If you drop that entire 50 grand cost onto your first year's expense sheet, well, your business is going to look like it's failing immediately. And that is where depreciation saves the day. Depreciation lets you spread the cost of a long-term asset over its useful lifespan. So instead of taking that massive, brutal hit in year one, you spread the truck's cost over, say, 5 years. Boom. Now it's a $10,000 expense per year, which is a way more accurate reflection of how you're actually using the asset.
Moving right along, Section 3. Funding and statements.
Let's see how this all builds together. Now that we know what we need to buy, the next logical question is, where does the money actually come from, and how do we track it? We've got a really vital comparison here. On one side, we have the means of finance. This answers the big question, where are we getting the cash? It usually comes from equity, which is money from you or your investors, and debt, like loans from a bank. On the other side, we have the application of finance. This answers, where is every single dollar going? This is your exact, itemized allocation for that land, that equipment, and your reserve cash.
Now commit this golden rule to memory. Total means of finance absolutely must equal total application of finance, period. If you walk into a bank and say you need $1 million, you have to show them exactly where all $1 million is going, every single cent. Whether it's raised from investors or a bank, it has to be perfectly accounted for. Honestly, there's just no room for a miscellaneous category when you're pitching $1 million project.
Once the money starts moving, you track it with 3 core statements. First up, the profit and loss statement, which simply tracks your revenue minus expenses over a certain period. Second, the cash flow statement. Now this one is absolutely critical because it tracks the actual cash moving in and out of your bank account. Listen, a business can look perfectly profitable on paper with a P&L, but if all your cash is tied up in unpaid invoices, you can still go bankrupt. And third, we have the balance sheet. This is essentially a snapshot in time showing what the business owns, what it owes, and the owner's equity.
All right, Section 4, metrics for bankable projects.
Okay, imagine this. You've built your entire financial model. Your CapEx is mapped out, funding is structured, statements are glowing. You walk into a bank ready to secure a huge business loan. What are they actually looking at? Well, they're laser focused on something called DSCR, or the Debt Service Coverage Ratio. It's calculated by taking the cash you have available for debt service and dividing it by your principal and interest payments. In plain English, this metric measures your project's ability to actually pay back those bank loans using the cash you have on hand. It's literally the ultimate metric lenders use to make sure they'll get their money back.
So, the crucial point here, the magic number you want to hit is a target ratio of 1.35. Think about it. If your DSCR is exactly 1.0, you are just barely scraping by, breaking even on your loan payments. But a DSCR greater than 1.35, that's what banks want to see. It proves to the lender that you have a 35% cash buffer sitting there above your loan obligations. Basically, it means if something goes slightly wrong, you aren't going to default on your loan the very next day.
To sum that up, if you want your detailed project report to be truly bankable and actually convince lenders to approve your financing, you need to hit this exact checklist. You need validated market research, so real tangible proof of demand, not just wishful thinking. You need sensitivity analysis, stress testing what happens if your raw material costs suddenly jump by 15%. You need crystal clear risk mitigation strategies. And, as we just saw, you absolutely need a healthy DSCR proving you can meet your obligations year after year.
And finally, Section 5, Sharing AI Explainers Safely.
Let's pivot for a second from traditional finance over to modern tech. Say you've got your Bankable DPR all finished. Now you want to share your project vision with your team or maybe the whole world, and you want to use modern AI tools to get it done efficiently. We see this question all the time now. Can I take an AI explainer of my DPR, like, say, one generated by Google Notebook LM, based entirely on my own notes, and just upload it straight to my YouTube channel? Are you going to get in trouble for that?
Well, the answer is yes, you can do it, and it's perfectly legal, as long as you follow 3 critical rules from our source material. Number 1, you must own the rights to the source material. If you feed your own original written notes into the AI, you're totally fine, but definitely do not use copyrighted books or paywalled articles. Number 2, retain the original AI watermarks. You've got to respect Google's branding and transparency terms. And number 3, YouTube policy mandates full disclosure. You absolutely must check the altered or synthetic content box in YouTube Studio when you're uploading. And this brilliantly illustrates a key distinction for creators out there. If you're doing unmonetized sharing, like you're just sending a private link to your team or you're fine with just getting some organic views, raw, unaltered AI uploads are completely fine. But if you ever plan to join the YouTube Partner Program and actually monetize that channel, watch out. YouTube's automated systems might flag a raw AI explainer as reused or inauthentic content. To actually secure monetization, you have to add real human value. You've got to transform it, maybe with custom visual assets, your own intro and outro, or human commentary to make sure your channel passes review. Wow, okay, we have covered a ton of ground in this explainer today. From mapping out the heavy lifting of CapEx and setup costs, to balancing your application of finance, hitting that magic 1.35 DSCR, and finally leveraging AI to safely pitch your ideas online. So I'm going to leave you with this final thought. The tools, the financial metrics, the modern platforms, they are all sitting right there in front of you, just waiting to be used. The only question left is, are you ready to build your own bankable DPR and share your vision with the world? Thanks for joining me on this explainer, and I can't wait to see what you build.